the market is very strong, as we can see, and seems to not be pricing in much risk out there. One of the things that concerns me is this fixation of interest rates, that rates have to be low for markets to do well. And historically, that's not necessarily always the case. In fact, most times in history, reasonable interest rate structures are consistent with decent economic growth, and low interest rate structures are actually sometimes consistent with weak economic growth, because it's more of an output than a cause. So in that, what worries us is why are interest rates so low? And I think part of that is the return on capital is very low. So if return on capital is low, the cost of capital has to be low to accommodate that, and the cost of capital is driven by interest rates. So with return on capital being low, which I think is a function of the deleveraging we're seeing in the world today, the issues we're having with demographics and sovereign risk and things along those lines, I think this does lead to a lower return on assets over time, which should mean that returns that people are getting from equities, fixed income, cash will probably be lower than they're expecting.